Hey, good afternoon. How's everybody?
Good afternoon, sir.
Afternoon.
Hi, Jason. Hi, hi. And who else was it? Antonio.
Yes.
How are you?
Good
Yeah, how
afternoon.
are
I'm
you?
doing
Good
good.
afternoon.
Thank you.
Good afternoon.
Hello,
How are you, Aura? You just joined, right?
I'm good, thank you.
All righty. So I see six people here in the collaborate, and let me just briefly check. If you guys all remember to sign into, yeah, I see like eight people actually. I see eight people in the discussion board. So yeah, I guess one more person is joining. I'm still, so there has to be eight people here in total so far. Um, okay, so I believe in our last class, so let me share my screen. Okay, so in our last class, we talked about, basically, three different classifications of, interest rates, lending rate, borrowing rate, right? Nominal lending versus borrowing rate, nominal rate versus real interest rate, simple interest rate versus compound interest rate, right? Um, we talked about, I believe, we discussed extensively about the real interest rate, inflation, and nominal interest rate, right? Didn't we? I mean, if you uh, the the fact that we are and last two last two classes were all Monday sessions, so we had like 2 hour sessions each day. So I believe we did extensively talk about that. So now our focus is on Fed funds rate because Fed funds rate, um, Fed funds rate is the baseline, is the bottom line of all interest rates. It's the basis of all interest rates. Why? Because it's the rate that is used between commercial banks. In other words, commercial banks borrow and lend to each other, borrow from and lend to each other, right? Um, uh, and when they borrow and lend to each other, um, the rate they borrow and they borrow and lend at the Fed funds rate. So Fed funds rate is actually a short for federal funds market rate. And what is a federal funds market? Federal funds market is the like online exchange, right? Online uh, venue where commercial banks uh, shop for borrowing, right? So the reason they borrow from each other, the reason they borrow or lend to each other is mainly for two reasons. Let me use this example, right? I already worked out. Um, Basically, banks have something called required reserve. Required reserve, right? And what is a required reserve? That's uh, uh, the minimal level of reserve they have to keep inside the bank. And the reason for that is um, if you look into the bank's balance sheet, right? In other words, uh, think about it. If you're starting up a bank, um, you must, for any business, you must have a startup capital, right? Startup capital. And the startup capital is needed for basically, acquiring an office space, acquiring the office space and, office equipment and, things like that. And of course, working capital, you need also have the startup capital will be also used as working capital until you um, generate the first round of income, first round of revenue from your business, right? So let's say the partners or investors got together, right, and chipped in $1 million as the startup capital. That $1 million is called equity because it's the owner's capital. It came from the owners, the investors, or the partners of this bank in this case. So the capital came from, uh, uh, you know, uh, 5 or 10, whatever, how many. If there are 10 partners, um, they all chipped in like $100,000. So the total equity was 1 million. So they start the bank, and then when they start the bank, then the people will come in and make a deposit. And there are two types of deposit: savings account, two types of accounts: savings account and checking account, right? So they have, in total, let's say they have, $1 million in savings and $1 million in checking. Okay. Now, so they have total of $3 million. That's called, total assets. This bank has the total assets of $3 million, and one third of that 3 million is equity. Uh, this is their own capital, right? Uh, the founding members' capital, right? And then the 2 million in savings and checking are basically a debt. It's liability, isn't it right? Because it's the customer's deposit. It's the customer's deposit, so it's the liability to the bank. But what is the main business of banking? We talked about this, multiple times. How does the bank make money? Hmm?
With
Anybody?
interest?
Hmm? What did you say?
How does the bank makes money?
Yeah, how does the bank make money? What's the main business of the bank?
Probably loans and fees.
Right, right. Loans and fees. Loans, yeah. Peter, right? So, of course, banks make money by lending money, right? So I'll give you 0.25 point for that, Peter. Um, the the main business of banking is in lending. I've been telling you this, over and over. Banks don't make money by taking deposit. Think about it. If they take deposit, they have to pay interest, right? So that's not the source of income. That's actually source of that's expense, right? So they have to generate income. And how they generate income? By lending money, right? Banks make money by lending money. So they will be all um, theoretically, if they can charge 10% interest rate, if they can charge 10% interest rate, and if they can loan out all of this 3 million, right? Then theoretically their interest income will be their revenue will be $300,000, right? So they are naturally tempted to make maximum lending. Isn't that right? They will be tempted to make maximum lending. So of course, that's what that's what incentivizes them to make lending. Um, this $1 million in equity, they have no problem lending 100%, right? Because it's their own money, whether they lose it or they make profit out of it, it's their own responsibility. I mean, it's owner's money. They don't owe it to anybody. Even if they lose it, um, you don't have any obligation to anyone, right? You don't have any obligation. Um,
Uh,
so they can loan out 100% of this, and then from these $2 million, right? The 1 million in checking and 1 million in saving, it's a debt. Although they are tempted to loan out 100%, um, if they lose, right? If they lose, then they have an obligation to pay back uh, the customers of the bank, the savers, right? So although they are tempted to loan out, they will have some hesitations. But at least this, 1 million in the savings, theoretically, they can loan out up to 100%. Why? Because the money in the savings account is a long-term commitment. I mean, let's say it's all CDs. All of this 1 million is in CDs. CDs are basically a contract, right? So if you have a 2-year CD account, that means you have a 2-year contract, and you can't take out money, right? You can take out the money from your CD during the contract period, because if you do, it's a breach of contract, and for breach of contract, you will have to pay penalty, right? And the penalty is only necessary because if you withdraw money uh, during the contract period, right, then they cannot make a long-term loan. They cannot commit to a long-term loan, right? If you take out money, then they will have to recall. If you take out your 1 million, they will have to recall that 1 million from the borrower, right? So they can't do that, right? Now, if you have something to say, please say it, because I can't. If you drop it in the chat box, I can't see it, right? Because I'm looking at this whiteboard and I don't know what's going on in the chat box. Okay, so if you have something to say to me, please say it. Okay. Now, and but if you're not stupid, I mean, obviously, when you're lending, think about it. Banks their business is other people's money, isn't that right? Banks are lending other people's money. Of course, if they are lending this, that's their own money. But any of this, right, checking or savings, if they are lending, any of this, that's other people's money. They have an obligation to take care of that money, right? So nobody will be stupid enough to lend to anybody, right? Even their money, they will only lend to the highest quality borrower. Highest quality borrower is also the lowest risk, right? Lowest risk borrower. And of course, lowest risk means, that they have collateral, they have good income, they have um, uh, excellent credit rating. And if they lend to such, high credit worthy borrowers, then uh, uh, you don't have to worry about not getting your money back, right? Also, with the savings, the money in the savings, they will do the same. They will be very cautious in approving the loan. They will be very cautious and selective in terms of their borrowers, right? So as long as they are cautious, right, using caution, then they can loan out 100% of this. Also, $1 million in the checking, 1 million in the checking, right? They will be also tempted to loan out 100% because why not? If the interest rate is 10%, they can charge. If they can charge 10%, then they will get 100,000 from lending out 1 million, right? So, but then, here's a problem with, your own capital and with the money in the savings. You don't have that much problem, but checking deposit has a problem. Why? The money in the checking account is a demand deposit. And what does that mean? Demand deposit is, the deposit that you have to, money that you have to give out when demanded. And how do you demand your demand deposit? By writing checks or by, making withdrawal from ATM, right? And so basically, that means you have to retain at least enough. You have to retain sufficient balance. The bank has to retain sufficient reserve balance in checking, so that sufficient enough, enough balance to handle all the checks that come in for clearing and all the withdrawals, right? Sometimes, the banks loan out too much and leave too little reserve. And sometimes when there is a bank run means a situation where people run to the bank to withdraw money. If there's a panic in the economy, then that's what happens. Something like, oh, there's a financial market crisis. They run to the bank, withdraw money before the bank runs out of money. So normally they will maintain optimal level of reserves in the checking, so that can handle most of the withdrawals. But sometimes, if they are banks go arm and a leg, banks go out on an arm and a leg, and banks make loans to a very risky level, and then they fail to meet the reserve requirement. So there is something called reserve requirement for checking account balance, and the reserve requirement is to prevent this type of bank run. Bank failure, because in checking account you don't have enough reserve, but people run to the bank and make withdrawals. They withdraw money, and the bank doesn't have money. Bank runs out of money. Then what happens? That's default, right? Right? If bank cannot pay you what you demand, if bank cannot give you what the lender, in this case, you are the lender, bank is the borrower, and in any situation, if borrower cannot pay back the lender, then that's bankruptcy, right? So the same thing can happen with the bank too. If the bank doesn't have enough in the checking account, then they can go bankrupt. So to prevent that, there is a requirement, right? Reserve requirement, which is set by the Federal Reserve. And in the U.S. economy, before the financial crisis, it was about 10%. Reserve requirement was 10%. Now, after the financial crisis, there is no reserve requirement. This is, you might wonder, reserve requirement is 0%. You might wonder, it was financial crisis. How could they do this? Shouldn't they retain some reserve? No, actually, during the financial reserve, you have to take the economy out of recession. So you have to expand lending. To expand lending, the reserve requirement must be lifted, right? So then what happens if the bank doesn't have enough reserve? I mean, if they loan out maximum, and if they have not enough reserve, of course, I said they will have to borrow from another bank then. I said after the financial crisis they lifted this required reserve. Although they lifted required reserve, the banks wouldn't be stupid enough to loan out everything. If they loan out everything, although they are tempted to, but if they loan out 100%, then they are sure to go bankrupt when suddenly customers, savers all run to the bank and withdraw money, and they have no money to give out. That's a problem. So no bank will actually dry up their reserves. But anyway, prior to the financial crisis, the reserve ratio was 10% in the U.S. economy. So if reserve requirement is 10%, that means at least $100,000 every day after bank closes. At least $100,000 must be retained within the bank. But sometimes they can't meet it. Then what do? They will have to borrow from another bank. So how do they borrow? They go into the Fed funds market, right? Federal funds market, which is, I told you, just an online exchange, online venue, right? So you look up, other banks that are willing to lend, and if they're, and so between bank A and bank B, they, if bank B is willing to lend, bank A borrows from bank B and pays 0.25% interest on that loan. But 0.25% is annual. Yeah, you understand. All the interest rates are basically annualized. This APR, annual percentage rate. So, and this borrowing is only for just overnight, right? Or short term, under 1 year. Overnight, right? If it is overnight, why? Because the next day when the bank opens, then there will be deposits coming in. There will be checks deposited, and there will be deposits coming in. So they will be okay. They meet the reserve requirement, and they can pay back the excess. They can pay back what they borrowed to bank B, right? At 0.25% interest rate. But of course, if they borrowed only for 1 day overnight, then it's not 0.25%. You understand? There will be an adjustment made because it's 1 day out of 365, right? It's going to be 0.25% times 1 over 360 or 365. And we talked about the difference between simple interest rate, exact interest rate, and ordinary interest rate in simple interest rate, right? We discussed that in our last class. So you should be you should have no difficulty understanding it. So another way the Fed funds rate comes into play is when they think about it. Why would why would Bank A borrow from Bank B? Of course, because their reserve falls below the reserve requirement. Another reason is, suppose Mr. X comes into Bank A trying to get $1 million loan. And the Bank A happens to be short. They don't have 1 million. They meet the reserve requirement, but they don't have 1 million to loan out. But Mr. X is a very high credit worthy customer, meaning he has excellent credit score. He has excellent credit score. So Mr. X is a very attractive customer to Bank A. I mean, they wouldn't want to miss out on this opportunity because Mr. X is going to most likely he's not going to default. I mean, he's a very credit worthy. Mr. X is a good low risk, very low risk borrower. So they don't want to turn him away. I mean, no bank will turn away a customer who wants to borrow as long as they have, very high credit rating. But they don't have 1 million. What do? They borrow from Bank B, right? And let's say, so they borrow 1 million at Fed funds rate. And let's assume Fed funds rate is 10%, right? Just to make it simple. And Mr. X borrows for 1 year. And since Fed funds rate is 10%, Bank A will have to pay back 1.1 million to Bank B 1 year later, right? Then they have to make that 0.1 million from lending out to Mr. X, right? So obviously the interest rate to Mr. X will have to be greater than the Fed funds rate. So let's say Mr. X interest rate to Mr. X is 0.20%, right? 20%. So 1 year later, Mr. X will pay back 1 million plus prime rate. I mean, 20%. 20% is certainly not a prime rate by realistic standards. But let's just assume, for our thought experiment, that 20% is prime rate, and Mr. X is a prime category customer borrower. So Mr. X pays back 1.2 million to Bank A, and Bank A will pay back 1.1 million to Bank B. So from this deal, Bank A gets 0.1 million, right? Bank A makes 0.1 million. And Bank B, 1 year later, that 1 million also came from their customer, Mr. Y. What did I say? Bank is in the business of lending other people's money, right? Isn't it right? Bank is in the business of lending other people's money to other people, right? So actually that 1 million came from Mr. Y originally, right? Mr. Y made a deposit of 1 million with Bank B, and Bank B will have to pay back Mr. X. And since Fed funds rate is 10%, and between the banks, between Bank A and B, Bank B makes 10%. So what the interest that Bank B pays to Mr. X must be lower than the Fed funds rate, right? It's not just a little lower. It will have to be very much lower. So let's say they pay 0.1%. They pay 1% to Mr. Y, 1% of 1 million. So what Mr. Y gets back is 1.01 million. 1.01 million. Now, doesn't this look familiar? Because when you when you lend to the bank, in other words, when you save money with the bank, you save your $10,000, and your interest is not even 0.1%, right? And which is the borrowing rate because it's from the bank's perspective, right? So if you so Mr. Y can be someone with an excellent credit score. Mr. Y can have like 840 credit score, but still, when he borrows, when he lends, he gets only 1%, right? But when he borrows, he will get, he will have to be charged 20%. So that's the difference between the lending rate and borrowing rate, and the difference between the lending and borrowing rates is called spread. And Bank B wants to maximize this spread, so they pay 0.1 million as interest to Mr. Y, and they keep 0.9 million, right? Because they were paid 1.1 million from 0.09 million. Not 0.9 million, but 0.09 million, $90,000, right? So this has to be. So everyone is okay? Everyone is following up to that point?
Yes.
Okay,
Yeah.
good. Okay, good. So 0. So that's why think about it. Currently, the Fed funds rate is 0.25. So the bank will have to, what we get is not even 0.1%, and that is why, because Fed funds rate is so low. Then the borrowing rate, right? When we deposit money, what we get is it will have to be less than 0.25, but the banks want to maximize that spread, so it's not even 0.0. It's not even 0.1%. It's lower than that in reality. Okay, so that is what how Fed funds rate works. But then Fed funds rate is the basis for all interest rate. All lending rates are basically built upon Fed funds rate. So that's why it's called benchmark rate. It's the benchmark.
Professor?
And when we say prime rate is conventionally about 3% above Fed funds rate, right? It's not codified. There's no code. It's not codified. It's not etched in stone, but conventionally 3% above Fed funds rate, 3 to 3.25. So currently Fed funds rate is 0.25. So the prime rate is 3.25, and the prime rate is the rate at which the prime category borrower, those with excellent credit scores, can borrow. So prime customers can borrow at 3.25, prime rate of 3.25. Okay, and one thing also, you must clarify. One thing you need to understand clearly is that the Federal Reserve, although Federal Reserve can influence the Fed funds rate, but Fed funds rate is not the rate determined by the Federal Reserve. It's controlled by Federal Reserve, but the Federal Reserve is not the owner of the Fed funds market. Federal Reserve doesn't run the Fed funds market. Fed funds market is run between these private retail banks, right? Retail banks, right? Commercial banks, not necessarily private. I mean, when we say private, also you must make a clear distinction. All businesses are, when we say public corporation sounds like a public corporation, like PBS, public broadcasting station. When we say public, it sounds like it's owned by public entity. I mean, or a government or state. No. Publicly owned when state-owned companies are different. State-owned companies are not publicly owned. It's not public. Publicly owned means company's ownership is open to the public, right? So actually, publicly owned company, publicly owned entity or publicly owned organization is not government owned or state owned. If it is state owned, it's privately held or privately held. Why? Ownership is not open to public, right? Ownership is only to the state or the government. So that's privately owned, not publicly owned. All the corporations that you heard, Google, Facebook, Apple, PSENG or Con Edison, JP Morgan, Bank of America, all of them are and cable companies, they are all publicly owned, right? Meaning, they are their ownership is open to public. You can, you buy their stocks, then you are part owner, right? Anybody can participate in the stock market. Anybody can buy their stocks. So it's publicly owned, right? So Fed funds market is held by it's not owned by the state Federal Reserve. It's only maintained. It's the marketplace between commercial banks, right? But Federal Reserve can influence the Fed funds rate. How? Not by issuing an order or decree, right? They don't issue an order, they don't issue an edict, and saying one day, let the Fed funds rate be 10% from today. No, it's not like that. Instead, Federal Reserve works through the bond market, right? Federal Reserve works through the bond market to change the Fed funds rate, to influence the Fed funds rate. So what Federal Reserve can do is basically they set the target rate, and through open market operation is basically bond market operation, they raise or they lower the actual Fed funds rate. So think about it. There is a difference between the target and actual rate, because target can be 2.5 or target can be 0, but in reality, because the actual rate will have to be determined by the demand and supply for funds in the Fed funds market, the actual rate or the effective rate will deviate from that target. But so the actual rate, the target will give a range. The target will between 0 and 0.25, right? There's a range, and within this range, right, the effective Fed funds rate or actual Fed funds rate will oscillate within this range. Okay, and Federal Reserve will intervene in the market to keep that actual rate within the range. Okay, so Federal Reserve's role is very important because Federal Reserve is the central bank of the United States. It's the ultimate authority in monetary policy. Okay, and Federal Reserve, as the monetary authority, Federal Reserve serves what they call dual mandate. It's basically keeping the price stability. In other words, the inflation within manageable, stable range, and maintain the full employment. Full employment doesn't mean 100% employment because there's a natural rate of unemployment, which is about 4%, 4 to 4.5% in the U.S. Full employment is never 100%. And then the central bank is also a regulatory authority in commercial banking, right? And the lender of the last resort. That means when commercial banks cannot borrow from each other, they will have to come to the Federal Reserve, right? But here, borrowing from the Federal Reserve is a kind of metaphor. It's not really borrowing, but it's like selling the bonds that they had to Federal Reserve, and in return they get the money. So it's not really borrowing in the like in the sense of please lend me some money. No, not like that. They put up something, right? They put up assets to get money in exchange. Okay, so that we already actually you guys owe me 10 minutes, but we're actually 5 minutes past the hour, so I will have to oh, it's 50 minutes. I'm sorry. It's 50-minute class. We still have time. I'm sorry. Always, 2-hour session we have. It's not exactly 2 hours. We finish at 1 hour 40 minutes point, right? 1 hour 40-minute point, and it's 1 hour class today. So we still have like 5 minutes. So but you guys owe me 10 minutes. So even if I call it a day here, it's not, unreasonable. Now, but the point is, in the only in the U.S., central bank is called the Federal Reserve. In other countries, central banks are all, like, Bank of England, Bank of Korea, Bank of, Japan, I don't know if it is Bank of Italy, but, it will be. And in France, what is the central bank of France? I think it is BNP, Banque Nationale de Paris, BNP. Otherwise, they wouldn't call it national, right? And in Germany, it's Bundesbank. Bundesbank is, like federal bank, right? But generally, all the other countries have the names, like bank, the country name of the country comes in there, right? Like Bank of Japan, Bank of England, Bank of Korea, but in the U.S., Federal Reserve, and commercial bank in the U.S., there has been a separation between commercial banking and investment banking. That was, after the, 1929 stock market crash, because stock market crash, 1929 stock market crash, uh, uh, that was the onset of the Great Depression. It started Great Depression. So um, after the since after the experience of Great Depression of that started in 1929, the Congress legislated a law called bill called a Glass-Steagall Act, and the Glass-Steagall Act separated investment banking from commercial banking, and it was held for almost 77 decades, and only around uh, 1998, Glass-Steagall Act was repealed, right? And then there was no longer distinction between commercial banking and um, investment banking, and that was the main cause of the 2008 financial crisis, letting these banks, all the commercial banks, jump into all kinds of investment banking uh, uh, field, right? Uh, increase the risk throughout the economy. So, uh, but so they are. Uh, I'm not sure if they have uh, reinstated Glass-Steagall. There is a movement to reinstate Glass-Steagall, but It's not been reinstated yet. But anyway, uh, regulatory authority in the investment banking is, we all know, Securities Exchange Commission (SEC). Regulatory authority of commercial banking is, uh, Federal Reserve. CFPB, Consumer Financial Protection Bureau, is the regulatory agency for non-banking institutions such as insurance, right? Or mortgage lenders, etc. Um, well, that's all the time we have for today. Uh, I I believe you all know that there's another practice test uh, starting this Friday, right? Everyone is aware of that, right?
Yes, the test is from
Okay.
the Roy videos 7 to 10.
Uh, yeah, it's basically all the videos, everything, of uh, everything. So it's everything after the first uh, practice test. So if you go to, okay, Keisha, you have a question, but before I answer your question, let me look. If you go to the course material, I have course materials already here. Why am I doing that? If you go to the course materials, uh, there are a lot of videos, right? And then there is, ROI and macro part one, all the way through part 10, right? And of course, these are no longer visible because they are more than 5 days old. But I gave you the YouTube, my YouTube channel. Uh, Everything that's more than 5 days old, it's there. You can find it there. Okay, and I believe Keisha had a question. Keisha, now it's your turn. You give.
No, Professor, never mind about my question. It was answered already.
Okay. Okay. Alrighty. So time is up. I'll have to sign out. So have a good weekend and good luck with your test. And see you next Monday. Okay.
Thank
Okay,
you.
Professor.
Bye
Have a
bye,
good
Thank you,
everybody.
Professor.
Good day,
All
Professor.
See you
right.
next
Take care,
Monday.
everyone. All righty. All right. Yeah.